Imagine two lives. One is a regular worker. They earn a salary, taxes come off immediately, they see a smaller paycheck. What remains pays bills. The other is very wealthy. Their net worth grows on paper. Stocks rise in value. Companies they own become worth more. Real estate increases in price. None of that is a paycheck. It often does not trigger immediate tax. This is the central twist. Income is taxed when it is earned. Wealth from assets can be taxed later, or at a lower rate, or not taxed at all for a while. Assets can be sold slowly. Owners can borrow against them. Borrowed money is not taxable income, so someone can live on loans, while their assets keep rising. There are also special rules for business income, and different rules for capital gains. Deductions often favor investment and ownership. Tax codes reward risk-taking in business. Philanthropy and trusts change tax outcomes. Timing matters a lot. Delaying a sale delays the tax bill. Shifting ownership can change tax rates. This creates two rule books in practice, one for wages, one for wealth. The rules look different up close. This is where legal strategies matter, and where ordinary workers and the rich diverge. We will explore how they use the rules, and why the outcomes can be so unequal. First, we must see the basic mechanics. We will look at taxes on salary, then taxes on capital, then how borrowing fits in, and how ownership changes things. Finally, we will tie it together. The goal is clarity, not judgment. You will see the mechanics. You will understand the incentives, and you will see where reform might matter. This section shows the two rulebooks. Keep that contrast in mind. It explains the basic advantage of wealth. Next, we dig into specific strategies. They play a different game with the same rules. First move, borrow against appreciated assets instead of selling them. You can use stock, art, or property as collateral. A loan is not taxable income, so you pull out cash without triggering capital gains. You keep owning the asset while you spend the loan. Second move, delay taxes by not realizing gains. Capital gains are taxed only when assets are sold. That timing matters a lot for wealthy holders. They let value compound before ever facing a tax bill. Third move, use businesses to create deductible expenses. Legitimate business costs reduce taxable profit. That can include salaries, benefits, and operational spending. Business structure and accounting choices change what counts as income. Fourth move, real estate depreciation creates paper losses. Depreciation lowers taxable income even as the building gains value. On paper, they pay less tax while cash flow remains positive. These tools are legal and common. They rely on timing, structure, and careful record-keeping. Add philanthropy for another layer. Charitable gifts and philanthropic vehicles can reduce tax liabilities. They also polish reputation and extend influence. Donor-advised funds and charitable trusts keep giving flexible. Finally, trusts move wealth across generations with control. Trusts can preserve family influence while shaping tax outcomes. The common thread is control over when and how income is taxed. Ordinary workers face immediate taxation on wages. The rich often delay, convert, and shelter income instead. That difference explains much of the tax gap we see. It is not tax evasion, it is tax planning within the law. There are costs and risks, including interest and market swings. Professional advice and precise paperwork make these strategies work. Understanding them helps explain why the wealthy pay less tax sometimes. Most of what we described is legal. It is not usually about breaking the law. It is about access and options. It is about lawyers and accountants who build strategies. It is about financial advisors designing plans. It is about assets that behave differently than paychecks. Some assets let owners borrow against future value. Some let owners defer tax bills for years. Some generate gains taxed at lower rates. Some offer deductions tied to real business activity. Some reward charitable giving with tax benefits. All of these tools change when and how tax applies. Most workers get taxed right away on wages. They have fewer ways to delay or change that timing. That timing matters for growth over decades. Having professionals also helps navigate complex rules. Those professionals also spot opportunities ordinary savers miss. That creates an uneven playing field of possibilities. This matters politically and personally. On a policy level, choices about taxes shape inequality. On a personal level, it shapes life choices and security. So what should you remember as a viewer? First, you are not always missing a moral failing. Second, taxes reflect legal distinctions between types of money. Third, knowledge and access change outcomes dramatically. You can learn the basics and use available tools. You can also support changes that make rules fairer. But never forget one clear truth. The rich do not just make more money, they often make a different kind of money, and the tax code treats that difference like a velvet robe. Like this video, subscribe to Old Money Files, and step inside the quiet world of real wealth.